Another trading channel. This video is about entry-level options trading concepts. If you don't already trade options, stick around because the covered call is the easiest one. If you own 100 shares of a stock, you can sell a call option against your position. In return for this call option, you receive a premium. This premium will vary wildly depending on the expiration date and strike price of the option that you sold. Call option is an agreement between you and another party indicating that if the stock moves to a certain price, you agree to sell your shares for the price you originally wrote. I'm going to give you a simple example. We're going to take Ford. Let's say you own 100 shares of Ford. Not judging, we're just using Ford as the example. And because you own these 100 shares, you can sell a call against this position. That really is the prerequisite. For every 100 shares you have, you can sell a call option against your shares. Now, in this example, we're going to say that you bought Ford and your price averaged $13, 100 shares, $1,300 into Ford Motor Company. Now, and you're up $51. It's at $13.51. Great. Well, if you come on down to the options chain over here, you'll see that for someone paying you $266, this 2.66 right here is the bid price. Now, this call expires in about 2.5 years. So almost all of the price is time value. $266 for the obligation to sell your shares at $15 and no higher. I'll say this again. Somebody pays you $266 right here. We're just going to say they paid the bid right here for the 15 strike. This means if Ford Motor Company goes to $8,000, you will never ever receive any more money than the difference between $1,351 and $1,500 plus the time premium. Okay, so you bought in at $1,300 and let's just say it goes way past 15 and this other party exercises the call option on you. You're gonna get the $200 in profit from $1,300 to $1,500 is yours. That is yours, because this person has to pay you $15 a share. They purchased the 15 strike, so they pay $15 a share for your Ford shares, which could be $1 million a share. They get them at 15, right? You get the $200, 13 to 1,500, and you get the time premium credit you received of $466 of profit. So it's almost like the only risk in a covered call is that you won't make as much. See, a call option is an insurance contract, really, for the person buying. But interestingly enough, a covered call is insurance for your position as well. If you intend to hold a position for a year and you have over 100 shares and there's an options chain for the stock or ETF we're talking about, it's absolutely just very dumb, in my opinion, to not write some sort of calls against it. See, you can write shorter dated calls and you'll just receive less money. I guess let's scroll up and look at an example of that. Right. So if you did the exact same thing, you sold the 15 strike for Ford Motor Company, but you sold it 1 week out, so expiring next Friday, it's illiquid. Nobody would buy it. No, it's $1. You would get $1. So that really emphasizes how much time is built into that premium you're receiving. That $266, I mean, it says it right here. There's no sooner strike than the November 11th. So this is the next closest date for this call option, and it's literally worthless. And then you come down to the year 2025, which is really far away, obviously. 2 years, and 2025 is worth $266. So, I mean, if you think Ford is just going to trade sideways for a couple years, and that's your strong conviction, this is what you would do. You would sell a call. You could sell dates in the middle of these dates on a regular basis and generate more. Well, it's hard to tell because whatever number we look at right now will be a different number. If, let's say, one way you could continually sell calls against it, and I'm not saying you would make more than 266 though. That's something that the 266 is yours, right? So until 2025, and then if it stays below 15, dude, that contract expires worthless. Did I not talk about that? I didn't mention that. Jesus. All over the place, dude. I hope you Listen, I hope you learned something. Okay, I'm not claiming to be the options god, not even close. I do know what a covered call is, though. Hit me up, dude. Let's let's get it cracking.